Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Greg Taylor, Chief Investment Officer with Pender Fund Capital Management, will be joining us for the hour. In 30 minutes, we'll be getting the latest Canadian GDP numbers. Jimmy Jean, the Chief Economist and Strategist at Desjardins, will be here for some in-depth analysis. And of course, we want to hear from you this morning on First Call. Reach out with your questions. We'll have Greg answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Gold and silver missed estimates for fourth quarter profit and revenue. On the upside, the Quebec-based company beat estimates on silver production. The miner says its silver mine in Morocco is now operating at steady state, enabling significant cash flow, further supported by a strong silver price environment. Looking ahead, Aya is focusing on advancing the development of another mine in Morocco, which is currently undergoing a feasibility study. Eli Lilly is buying Centessa Pharmaceuticals, a deal worth about $7.8 billion US. Centessa, is developing drugs to treat sleep-wake disorders, including narcolepsy. Lilly will make additional payments if 3 milestone targets are met. This comes as the obesity giant seeks to expand its portfolio into treatments for sleep disorders. The euro area saw its steepest jump in inflation since 2022 as the Iran war continues to push costs higher. Consumer prices rose 2.5% in March from a year earlier. Governments and central banks in the region are slashing their projections for economic growth, and companies are bracing for a hit to demand among consumers. The European Central Bank is expected to make a decision on interest rates next month. And now our top line story. Donald Trump has taken to Truth Social, telling allies to buy U.S. jet fuel or take it from Hormuz, adding that allies need to learn how to fight for yourself. For more on the continued market reaction to the conflict in the Middle East, let's bring in our guest for the hour, Greg Taylor, Chief Investment Officer with Pender Fund Capital Management. Greg, thanks as always for joining us.
Thank you.
And we're going to talk about Donald Trump and oil again today. Surprise,
Shocking.
surprise, surprise. The latest on this, he's telling Europe to go get it themselves if they're not going to work with him, and that NATO may be in trouble. How is markets going to react? How is oil going to react to this, do you think?
Well, it's surreal almost right now. And it's just so much headline risk in this market because just an hour ago, the tweets were coming out that it looks like he was ready to end the war and have a deal. And futures were higher and oil was starting to pull back. And then these headlines come out and it kind of reverses everything. And it's really got a lot of traders just on their behind feet right now because no one knows what to do. You don't want to make a big bet either way. And you can't because you're just so susceptible to something that comes out of left field and it's just going to whipsaw everything. So it feels like, though, this has dragged on long enough that the markets are getting close to capitulation. We saw a bit of that last few days. And you do want to hope that maybe we've got all the sellers out of the way. A lot of the program trading is done and we will start to see the end of this. But it's still really too hard to make a bet. And maybe getting the quarter over with is going to be a blessing. And we'll see what happens in spring.
I think everybody's ready to think about it this quarter.
Yeah.
But when you say close to capitulation, what do you mean by that?
When you look at different sentiment indicators, we're looking at investor sentiment indicators getting almost as bearish as they've gotten in the COVID time. We're seeing the VIX, which is a volatility spike, start getting over 30 and having a pretty big move up. And that's just showing that investors are starting to get worried. They're getting capitulation, or no one's taking on any big bets. We're seeing volumes really dry up in the market. So again, people aren't day trading because that whole buy the dip mentality that investors were really living off of for the last 18 months, it seems to be fading away. So it's really uncertain, but it's kind of one of those things that you really hope that we're getting close to these pain points. And we're starting to hear a bit of a tone change out of Washington. And maybe that's the signal to the close to the end.
And there really haven't been any dips to buy lately, have there?
Well,
there's been some big dips, but if you keep thinking that that's the dip.
Absolutely. And we've been ending every week, it seems like, on the lows. And that's just a sentiment trader right now that no one wants to be long into the weekend because you never know what headline's going to come out. So we're definitely seeing this volatility where you get these gap opens, but they seem to fade throughout the day. And then you always get this fade into the weekend, which just goes to show that there's a lot of nervousness out there and people don't want to take on any long positions over the weekend.
And what do you think of the idea that he essentially said, well, maybe we'll pack it up now, we're done, and Iran can run the Strait of Hormuz?
Well, I'm not sure what that solved at the end of the day. Then we just had this 4+ week conflict, and it's actually coming out in a worse case scenario than when we started. So I got to think that's a bluffing or posturing again, but it's really trying to get other people involved. And I think he's really realized he's bitten off more than he can chew. This wasn't going to be as easy as Venezuela, which I'm not sure whoever told him it was going to be. And now we've kind of got this whole destabilized. We've got potential inflation globally and a lot of pain through lots of parts of the global economy. And there's no really way out of this. And if he just walks away right now and goes back, I think that's leaving us in a much worse situation than we started.
I mean, we're seeing reports, the UK, they may be running low on jet fuel.
Yeah, and I think this is there's so much just-in-time inventory that's out there in the system, and the longer we've been backed up without getting a refined product or any energy product coming out of the Straits of Hormuz, that's going to hit jet fuel first. But now we're going to start to talk about fertilizer, and is that going to affect the global crop? And supply chains are really running with tight inventories globally, and they have for decades, and that's going to be something that's going to creep up into the market for the second half of the year.
And is oil at a price you would expect it to be with everything that's unfolding?
It's probably still a little discounted because it still feels like it could go a lot higher if this thing drags on a lot longer. There still seems to be an expectation that this isn't going to last longer than a few more weeks, and we will start to get more normalized activity. But until that happens and the longer this drags on, I think you could start to see oil creep up higher. And we're now just starting to see how oil is imported in everything that we use, and that's why prices are coming up, and that's where we're starting to see this tick up in inflation numbers.
And I think in the U.S. we may see a reaction because we're seeing the magic numbers, over $5 for diesel and $4 for regular gas.
Absolutely, and that's going to have an impact on the economy. We're starting to hear some companies start to pull back on guidance about what the lower-end consumer that's more susceptible to this is going to do. But this isn't a good outcome, and I think the market really did think this was going to be a quick event, and the longer this drags on, that becomes more into doubt, and it's going to be really hard to see what happens in the second half if this drags on.
And I guess, so, I mean, if this does wrap up somehow in the next week, that's a 5-week war. That's still a pretty quick war when you look at something like Russia or places in Africa, Sudan, civil war in Sudan. I mean, those things have been going on for years.
Oh, absolutely. But I think this one has more that impact with that Strait of Hormuz, and really how it's cut down all global supply for some really key ingredients. And that might have been something that wasn't factored into this. You think they would have thought this out when they were going into this. But right now, as the Russian-Ukraine war has dragged on, this war is really having more of an impact globally, and we're starting to see parts of Asia shut down or tell people to work from home because there's not enough supply of crude to keep the power lights on. So this is having a bigger impact on the economy and more wider-ranging implications.
Yeah, shorter work weeks that's on Sri Lanka. I'd be okay with that.
Okay.
That one might work for me. All right, we have to take a break right now, but stick around, Greg. And up next, we'll take a look at the markets before the bell. See how things are shaping up on the markets. We'll start with U.S. futures, and apparently some optimism over some of Trump's comments, depending on which ones you interpret. And right now, they're interpreting the optimistic ones, and the Dow up by a point. They're all, look at that, all around 1.04, around 1% right now. They are up. In Asia, different story, a real mixed bag there. The Nikkei have been volatile. And it's down. It closed the day down 1.58%. Hang Seng up by 0.15, and the CSI 300 off by 0.93. Heading over to Europe, and things in the green there. You can see the FTSE moving well above 10,000 again, up by 0.95 right now. CAC 40 up by 0.6, and the DAX by 0.8. All of this on that optimism on the comments. And the TSX yesterday finished ever so slightly down, back below 32,000. It's down about 7% for the month. Some of the winners and losers from yesterday on the TSX. Abra Silver up nearly 6%. I Gold also up 5.2. See what happens today with I on its earnings. 5N Plus down 9.3, 9.4. And America's Gold and Silver off by more than 15%. And looking at the metals today, they are rebounding. Gold moving back up. It's up about 4,600, up 1.25%. Silver also rallying a little bit, up 3.9 almost at 73. And copper up today by about 0.6 to 554, still off its highs over 6. Taking a look at oil now. Western Canadian Select yesterday. Another day, another gain, up 2.5% to 83.39. And today, WTI, what's it doing? How's it reacting and everything? It's up again, a little under a percentage point at nearly 104 a barrel. Well, Greg Taylor is with us for the hour. He's the Chief Investment Officer with Pender Fund Capital Management. And with everything that's going on, bonds are catching your attention.
Yeah, and I think this is probably the biggest factor that's changed versus what people were looking for coming into the year. This was supposed to be the year we'd come in and the Fed chair was going to change with Powell retiring and Trump was going to appoint someone more dovish, and we get a lot of rate cuts. And that was kind of the underlying assumption. And we came into this year with bond yields trending lower, and everyone's expecting yields to keep dropping throughout the year, which is really good for the economy and good for certain sectors. But we've had a pretty big pivot of late, and a lot of this is due to oil and the problems in Iran and having oil spike, and that's inflationary. And we've now had a fairly big change in market expectations about rate cuts and what we're going to get at all this year. So we've had a big change from the U.S. where it's expecting 2 to 3 rate cuts was built into the year, and now we're basically at flat. Mm-hmm. And we're seeing that with bond yields move higher too. And this is really something that's caught a lot of investors off guard. And when bond yields move higher, stocks generally move lower. And I think that's the biggest thing we saw in March. And that's the biggest change for investors right now as they're looking at the macro backdrop.
And there was for a while, it was kind of going against that. Is this more now a normal reaction for bonds?
Well, I think what I think you're getting to, and which is right, is that we're starting to see the U.S. dollar work as a safe haven again. And usually when times of geopolitical risk, the U.S. dollar goes up, yields go up. And we're starting to see that kind of go the opposite way lately for a while as people are starting to lose faith in the U.S. dollar as a safe haven and such. But it's starting to go back to more normal, and bond yields are going higher because of this inflation argument. And I think this is really going to have an impact on just general asset mix, what sectors are going to work, and who's going to actually come out ahead.
And what are you doing with that, with those bond yields?
Well, the big thing to watch is just spreads. And this is where I think a lot of people are catching off guard because we haven't seen spreads really blow out, which means you're not getting compensated for taking on undue risk or another risk in corporate bonds. So you still really need to be conservative in your bonds. I think you got to watch them, and you really got to make a sense of when we're going to see rates come lower, because as long as oil stays higher, bond yields are going to stay higher, and these promises of rate cuts seem to be fading away.
And with gold, what's gold a factor in here with that?
Well, gold has been mostly the defensive aspect, and it's supposed to work in times of inflation. But with the U.S. dollar moving higher, that's kind of throwing a wrench into that. And we saw gold and silver have really ugly months in March, which is kind of.
But now they're bouncing back though a little bit.
Well, they're a little bit today, so hopefully we
so.
can finish this month a little bit stronger. But when you look at that chart and see what the gold price has done, that's not really what you'd expect in a time of this big geopolitical risk and higher inflation. This is supposed to be when gold works. So it may be the setup because we came into the year with some big runs and we saw that big spike in January. So we had to give some of that back, and maybe there's fast money involved. But I think the setup in March is more of a buying opportunity more than anything else. And I would look at this as an asset class that still has some really good underlying trends that you want to look at gold longer term. And gold could be one that we can use this dip as an opportunity to add to.
And now, when you say gold, are you talking about gold itself or gold companies?
I would look at both the gold companies and the gold miners. I think both are going to be good commodities. I think there's more of a multiplying effect in the gold companies, and they have underperformed the commodity for the last year. So I think this dip is really a good opportunity. They've been stocks first, and stocks first is everyone's selling what they could to raise some cash in the last few weeks. But this is something I think you want to look at for longer term, and gold is looking good here.
And with gold, is it moving away from the traditional concept of safe haven, do you think?
I think it has a little bit because it's becoming more of a real asset, and I think that's more of a protection against the devaluation of the U.S. dollar. That's been a big trend that's been going on for the last few years, where the U.S. money printing, global money printing, has been so severe that you're seeing a devaluation of just fiat currencies, and people are looking at what can work in that environment. And gold really popped up, and we all know what gold did last year with being one of the best asset classes, and had a pretty good start to the year, gave a lot of that back in March, but I think this is a buying opportunity that you want to take advantage of in dislocations.
Okay, and the bonds were how much Like, what are you running at with bonds percentage-wise?
Well, I think you still want to be kind of at the lower end of your range in bonds right now because you're not getting that risk reward from with tighter spreads. But I think it's going to be a good diversification aspect. I still think you want to be more higher quality value equities is really going to be where you're going to find the best risk reward right now. But bonds have to be on the radar screen. And if we do start to see yields start to pull back, then you can start to allocate and add duration.
And within the bond market, any bonds better outside the U.S. or is it stay U.S.?
I think U.S. and Canada is probably where you go. There's some looking at emerging market bonds, but emerging markets are really under question right now with this move higher in oil prices because they are more susceptible to this. But
we're seeing it in South Korea right now, aren't we?
Absolutely. But the emerging markets have been looking like a good risk reward. And coming into the year, the trade was everyone said let's tilt towards emerging markets as where we want to go in equities and fixed income. But this move in energy prices is causing that to be more question.
Okay, and then with rates, I don't even want to guess anymore what might happen because I mean we were talking cuts maybe, now that looks like it's off the table in the U.S. and in Canada we were talking maybe stand pat. Now we're talking somebody saying 3.
Yeah, I think Scotia was out yesterday talking about 3 rate hikes in Canada by the end of the year, which is really something that's surprising a lot of people and was not on the cards when we started the year. So that again is going to cause a lot of uncertainty and pressure some valuations and hit that consumer, which is already a little stretched with inflation and housing prices. All
right, we're going to take a break on that note there, Greg, but stick around, lots more to talk about. We'll be back with Greg Taylor, Chief Investment Officer at Pender Fund Capital Management, to see why gold. We talked about it a little, we're going to talk about it some more and why it's on his radar. Time to see what's on the radar for Greg Taylor, Chief Investment Officer with Pender Fund Capital Management. And we're talking about gold. We're going to talk a lot more about gold right now because that is what is on your radar right now. It's just looking at the 5-year. And I mean, if you bought 2 years ago, even with the pullback that we've seen, you've doubled.
Yeah, and I think those underlying trends that are the reason why it's doubled last year are still really in place. And we've had some short-term profit taking. I do think a lot of fast money got involved in gold to start the year, and we saw a lot of just technical buying, and it got overbought. Like everything, commodities do happen, get overbought, especially in short-term moves like this. But this pullback we're getting in March, I still think is a really good buying opportunity. And we've been looking at allocating more to gold across different funds that we manage. And this is something I think a lot of investors should be looking at because when you look at gold, you're looking at something that's going to be more of a store of value that is going to protect you against that devaluation of fiat currencies, which we all know and we've seen since COVID with the amount of money printing coming from central banks has just been obscene, and that's global. Mm-hmm. And really, when you've got that much money printing out there, what that does at the end of the day is devalue fiat currencies, so that paper money, it makes it less value. And the way to protect against that is looking at real assets and commodities. And gold being the first one of these was the first one to really benefit, and that's why it was up at nearly 100% last year. And those trends are still out there. We're still seeing money printing. This war in Iran is really deflation, is really going to be causing more money printing and to blow out deficits again in the U.S. So I don't think that trend is going to go away. And then we're also just seeing central bankers that are switching away from just holding all the reserves in U.S. treasuries, starting to question that they want to have an asset in their treasury that's backed by Donald Trump. And they're trying to look at something else that they can put on, which is gold. And they're starting to see a massive buying in gold from central banks in China and in Asia and Russia, of course, have been buying more gold. And this is something that's really going to be in place. So if you want the underlying trend of protecting against devaluation of fiat currencies, more central bank buying of gold, there's still supply demand, not a lot of gold mines coming out there. So that works in your favor as well. And those trends are still in place. So as much as gold was painful for March and we had that pullback, I think this is more of a buying opportunity than anything else.
Is there anything that might challenge it right now?
Well, the biggest thing that would challenge it is if we do start to see people just come back to the U.S. dollar. And that's really what the big trend was in March, is that we had people rush back to that safety of buying the U.S. dollars in times of stress, and the dollar spiked and gold pulled back. If that theme keeps going and people say, well, I just need to keep buying U.S. treasuries and gold, and that's what I feel is the most stable asset in the world, then that's going to cause gold to pressure. But really, when you look at what's going on in Washington and the deficit and heading into midterms, I don't think many people are going to say that the U.S. is the most stable thing in the world right now. So having some more real assets, having something in the commodities like gold is something that I still think is going to be a good part of everyone's portfolio. It doesn't have to be all of your portfolio, but sitting that 5 to 10% weight is probably not a bad batting allocation.
And And silver, anything like that? No, yes.
Well, silver is just its own beast, and silver is that hybrid metal that has some of the precious metals quality. Also has a lot of industrial uses from solar panels and different attributions in electronics. But it's also more high beta, and silver is generally thought of as a byproduct to a lot of gold mines. So its supply can be out there, and then the other aspect is just the amount of supply that can come on from people melting down their silverware or scrap metals and stuff there. So silver is more volatile. It definitely saw that run when it had almost 100% run in the last few months, and then has given that back and down double digits in the last few weeks. But it's the more high volatile play to play, but it's got the underlying themes behind gold too.
All right, and then what about gold miners and royalties, things like that? How are you treating those?
Yeah, well, they're all looking interesting right now. I think when we had such a fairly big pullback in March, I don't think you have to go too far away from the seniors. So just look at the Wheaton Precious Metals, the Agnicos. Those are good companies that really aren't going to take on a lot of risk. They've got good balance sheets, and they've pulled back with the entire group, and will probably rebound when the commodity does as well.
And not worried about any further drops in gold. They're still pretty solid, even if the price drops.
Yeah, they're solid balance sheets. They're good miners. They're good operators. Wheaton Precious Metals is a pure royalty company, so you don't have to worry about operation risk. It's more just the price and the multiplier around that. And then you look at just the big seniors like Agnico, which are working in really good, safe geopolitical jurisdictions like Canada, which you hope is safe, and we can work on in theory, and don't have to worry about that. Just to worry about the commodity price.
And is there more gold coming on the market? We touched briefly on it. Are they finding more mines? Are there more mines coming up?
Well, they're starting to look now. The thing is, we went through a 10, 15-year period where there was so much money just focused on technology and consumer and away from the resources that no money went towards financing the juniors. So the juniors weren't out there exploring. The seniors really started to focus more on their balance sheet and operations. So there hasn't really been a lot of exploration done over the last 10, 15 years. And when you look at it taking 15 to 20 years for a mine to come on from exploration to first gold pour, this is something that can't be fixed fast. So you've really got there's not a lot of out there. We've got a few mines in construction in Canada right now, but there's not a lot of big ones out there, and I think that's going to be a trend with us for a number of years. All
right, we've got to wrap it up there. We've got lots more ahead, though, after the break. Stats Canada releasing the latest GDP numbers. Jimmy Jean, chief economist and strategist at Desjardins, will be here for some in-depth analysis, and our phone lines will open up as well for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Well, Stats Canada has just released the January Canadian GDP numbers, and real gross domestic product edged up by 0.1% in January, marking a second consecutive monthly increase driven by growth in goods-producing industries and along with oil and gas as well. For more reaction and in-depth analysis, we turn to Jimmy Jean, the chief economist and strategist at Desjardins. Jimmy, thanks as always for joining us.
Thanks for having me.
Okay, I know the numbers literally just dropped, but up by 0.1. I think we were expecting it to be essentially unchanged.
Yeah, that's right. The consensus was looking for the flash was indicating an increase, but I think for the month of February, that's where the consensus was looking at for something flat, and then it looks like we may have had another increase in February. So those are good, I guess, starting points for the first quarter in 2026 as a whole.
To that point, given so much has changed in the world since the January data has come out, are people going to look through this number, or is this going to have any impact on the bond market?
I would suspect so, in the sense that the information contained in here will be still knowing what's ahead of us. Now, what's ahead of us in Canada is really different from what's ahead of the U.S. or European countries, for that matter, in the sense that Canada is a net exporter. So therefore, we have a positive terms of trade shock that will boost our Canadian outlook here in Canada, in the provinces in particular that are oil producers. However, in provinces where there are net consumers, obviously this is going to have a similar impact on disposable income, on real disposable income, and on household purchasing power than you have elsewhere. And that's why the Bank of Canada is sort of in a bind here. The next few numbers, I think, will start to give us a sense. But I think by way of really getting some traction in the oil sector, by way of production and those things, it might take a few months. So we might observe it more over the course of a quarter or so.
Yeah, we saw, just looking at the numbers, oil and gas was up 1.6%, offsetting December's contraction. Does that bode well heading into the next couple of months of numbers?
Right. I think it's a sign that it's an industry that's been one of the more resilient one. We have to remember this is one of the least targeted industries, and for reasons that are pretty obvious, but the least targeted industries when it comes to U.S. tariffs. Same thing when we look at oil producing provinces. That's where the effective tariff rate is the lowest. So you don't have the kind of obstacles on that sector that you have elsewhere. But even looking at some of the other sectors that you would typically think would be in difficulty right now. Things like retail are not performing too bad here. So the economy does have some level of resilience. We saw that in the fourth quarter with domestic demand. Even though we had a contraction on the top line numbers, we did have domestic demand actually rising 2.4%. So coming in very strong. A lot of that is heavily influenced by the government and particularly defense spending. So we saw those numbers influence the quarterly data. I think it's something we're likely to continue to observe as those announcements regarding defense continue to roll in.
You kind of touched on it, but there's all this concern last year with tariffs and just the threat to the Ontario industrial base and auto manufacturing. Are we starting to see that bite yet in the numbers, or is it still just been something that we've been able to skate through?
Well, I think overall, we're still in a position where those tariff rates affecting Canada compared to what other countries have to deal with, for example, China. Well, Canada is still in a relatively good spot. It's really those sectoral tariffs that have created that pinch in some of those targeted industries. So the wood products industry, steel, aluminum, we know who they are. But overall, once there was that sense of that awareness that CUSMA was still applicable, and therefore nothing was really changing for the vast majority of exporters. That's where you start to see confidence rising again. Now, exports are still under pressure, to be sure, but you are seeing interest in diversifying and looking for alternative markets to try to gain that resilience. It will take. It's going to be for the long haul. It's going to take some time. We're starting from afar. Exports to non-U.S. countries are just a fraction of our exports, really. But you have a movement of magnitude that you haven't seen in the past. So I think that's looking up. The other thing is that we've seen, the fact that retail came in positive, and we saw the retail sales numbers as well, surprise to the upside. That's a good sign in a context where we have a job market that's been struggling since the start of the year. So we'll have to see the next numbers to see whether that was just a blip and whether we see a little bit of a recovery there. But the fact that retail actually held up gives an alternative view as to the state of the economy and the domestic economy. That's not as bad as we could have feared from earlier numbers.
Now, with the manufacturing compared to the energy, are we in danger of becoming a tale of two solitudes, but more the East and the West? West is the energy, and with the manufacturing taking a hit right now. And how does the Bank of Canada balance those two?
Yeah, it's sort of, and we've been through that before. It's sort of the Dutch disease version 3.0, if you will. But it is a risk at this point because we have to think that the oil shock that we currently live through might be temporary. At least that's what we assume. We have an oil shock that lasts about 2 months, and by the third quarter. Our baseline view is that oil prices converge back to the previous range, the $60 to $70 range. Of course, there's a lot of uncertainty around that. But if it were to last, and you would have that two-track economy indeed, where oil-producing sectors would benefit and manufacturing exposed. The highest effective tariff rate is in Ontario, it's in Quebec, and those economies struggling. Now, the big difference versus the past is that you used to see the Canadian dollar rally when oil would be as strong. Now, we haven't quite seen that, perhaps against other currencies, but against the U.S. dollar, given the safe haven flows into the U.S. that we've seen, we haven't seen the Canadian dollar rally. And usually it's that rally in the Canadian dollar that further harms manufacturing producing provinces. And you're not seeing that now.
Okay.
But conversely, you have the CUSMA uncertainty that is weighing.
All right, we have to wrap it up there, Jimmy, but thanks as always for joining us.
Pleasure. Thank you.
Jimmy Jean is chief economist and strategist at Desjardins. Still ahead, NASA is sending astronauts back to the moon for the first time in more than 50 years. We'll take a closer look at the mission after this. And our phone lines are open. Greg Taylor, Chief Investment Officer with Pender Fund Capital Management, is taking your questions on stocks. Call us at 1-855-326-6266. You can email us as well. First call at bellmedia.ca. Well, NASA is sending astronauts, including Canadian Jeremy Hansen, back to the moon. Okay, not going to land on the moon, but they're going back, which is really exciting. First time in more than 50 years. For more on the launch, we're joined by Bloomberg's Lauren Grush, who is down in Florida. Lauren, thanks very much for joining us. Let's talk. You're down there. What's going on down there now? And let's talk a little bit about the mission plan for Artemis 2.
Sure. So technically it's L-1. We're 1 day out from the planned launch date, which is tomorrow at 6:24 p.m. Eastern. And yeah, I think you can feel it in the air. More and more people were showing up yesterday at the launch site. I imagine there's going to be even more today. We have one final press conference before tomorrow, and all indications seem to point to they are ready to give it a shot on Wednesday. So, fingers crossed that no more issues crop up between now and then.
Well, hopefully they don't get the rain that we're getting up here in Toronto right now. What will they be doing? I know they're not going to land on the moon, but close enough.
Right. Well, I like to call this an elaborate dress rehearsal for the moon landing. So they will actually be slingshotting around the moon. So they're not getting into the moon's orbit. They're just going to go around the moon. But it's still the closest that anyone has come within the moon since the Apollo program that landed humans on the moon back in the 1960s and 70s. And the goal of this mission is to test the two primary components, which are NASA's Space Launch System rocket and the Orion crew capsule that they'll be riding in, to make sure that they are safe and can work as planned. And because those two vehicles will also play a pivotal role in the moon landing in the coming years.
All right, and when they do that slingshot around, are they going to have that blackout time where we won't hear from them for a little while?
Be a period of time.
Oh, hang on. Sorry, you cut out there a little bit. If you could just repeat that, please.
There is a period where we'll be in a blackout, but they should be the advantage that we just that will be an exciting moment for them.
Oh, I can only imagine. Just going to the moon is exciting. And so what's next then after this? We're losing you, but hopefully we'll be able to get this answer before we have to cut it off.
Yeah, sorry. Blame the hotel Wi-Fi that I'm in. I'm on here, so it's in Veritas, But sorry, repeat your question again.
What's next then for the Artemis program? They're up. They're going to go around. They're going to come back. What happens next?
So after this, there's going to be a test mission called Artemis 3, and that's supposed to launch next year, and that will send a crew on the SLS and dock with landers that are being built by SpaceX and Blue Origin, one or two of those landers. And then after that, that will be the moon landing in 2028, and that will entail using one of those landers from either SpaceX or Blue Origin to land humans back on the surface. There's a lot that has to go right between now and then, but it's definitely an exciting time to be covering this program.
Absolutely. We're gonna wrap it up there, Lauren, but thank you very much for joining us.
Thank you so much for having me.
All right, Bloomberg's Lauren Grush. Now, hopefully Artemis doesn't use the Wi-Fi from that hotel to get to the moon. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets. Let's take a look at some of the notable analyst calls and recommendations. Phreesia stumbles in the pre-market after the healthcare software company lowered its full-year revenue forecast far below the analyst consensus. At least four brokerages, JP Morgan, Citi, Baird, and Trust Securities, have downgraded their rating on the stock. TD Cowen cut the recommendation on consumer products company Colgate-Palmolive to hold from buy, citing intensifying resin cost headwinds from the Iran war. Shares are down in the pre-market. They lower our EPS estimates for HPC companies to reflect our view that they cannot fully mitigate higher oil-related input costs stemming from the Iran war, analyst Robert Mosca wrote in a note. For more, let's bring in Greg Taylor on this, Chief Investment Officer with PenderFund Capital Management. Oh, we lied. We're not going to bring... Greg, sit back, Greg. We're not going to bring you in there. I watched Greg's head pop up over there. What? I'm joining the conversation. Ottawa and Ontario have come up with ways to cut the cost of buying a home. There's been a major agreement on housing, which Premier Doug Ford calls historic. CTV's Annie Bergeron-Oliver has more on what it means to you if you're in the market for a home.
Ready?
After 6 years living in a suburban townhouse, Brittany Roddick is ready to upgrade to a bigger home with more space to play catch.
We wanted something with a bit of a bigger backyard and just room to grow. So we're choosing...
Roddick has a new build and a lot all picked out. The only thing she's waiting for is the government's promised tax relief measures to officially take effect.
As soon as we heard this announcement, it was like a feeling like we won the lottery. Like, wow, now... Not only can we absolutely move forward with purchasing the new home, but we are going to really make it feel special to us.
Starting April 1st, the Ontario and federal government are removing the GST, HST on the purchase of new build homes. For properties valued up to $1 million, that's a 13% savings, or up to $130,000. On homes between $1 million and $1.5 million, the rebate maxes out at $130,000. For properties $1.8 million and over, it's a max of $24,000.
We got to keep taking action until we get the desired effect of getting the market going again.
Ontario and the federal government are also committing $8.8 billion to help pay for infrastructure projects, so municipalities can reduce development charges by half for 3 years.
They've increased a massive amount over the last 25 years. So the City of Toronto, they've increased by over 5,000%.
The Conservatives doubt the temporary changes will lead to lasting results.
Developers will see this as a good start, as something that will help get things moving again. The problem, of course, is that what's missing is, as I said, some long-term commitment to reducing this expense.
And that was CTV's Annie Bergeron-Oliver. When we come back, Greg Taylor, Chief Investment Officer with PenderFund Capital Management, takes your questions on First Call. Time for first call and first email, and that belongs to Paul. If interest rates are increased 3 times as suggested, can you provide some thoughts on how that will affect bank stocks? Margins between loans and deposits may increase, but defaults could also increase.
Yeah, so that's an excellent question. And the big thing with the bank stocks is all just trying to figure out the steepness of the curve, because they lend short and they borrow long. And it's just, they really want to make sure that's a steeper curve so that they're not paying much on their deposits and they're making a lot on the longer term mortgages. And
they're making money.
Exactly.
Yeah.
And that's when banks are good, and that's when economies are healthier. And we've had a flattening of that yield curve. So if you start getting some more rate hikes, which is probably more of a risk, it's going to start to flatten that rate curve again. So I'd say that's potentially more negative to neutral for the bank stocks, and that's because it's all going about that yield curve. So if you start to see hikes in the shorter end, which makes me have to pay more on the borrowing costs, but then you have the longer term, if they don't actually go up in parallel, you're going to see a flattening out, and that's worse for the business models of the banks.
Because even when the Bank of Canada rate came down, we didn't see a lot. We didn't see as much of a drop with the banks, did we, on their mortgage rates and things like that?
No, we haven't, because that's almost a margin accretive right now, because they're still able to keep their mortgage rates higher, but not to pay as much on the deposits.
So they're making money. Okay, so for now, it's going to be a negative if we see that.
It's probably a negative if it catches off guard, but it's all about, you got to watch that yield curve and see how it moves, and if it's steeper, it's better for the banks.
All right. Has there ever been another time where we'll have to see? We'll have to see.
Probably
if
always.
This happens, we'll have to see. Yeah. Okay, this email is from Peter. It says, would you comment on the positives and negatives of buying a company like Meta on the Canadian exchange, partial shares, versus buying the company on a U.S. exchange? I'm asking for my grandson. He's 11 years old, for his early start TFSA. I didn't know there was an early start TFSA.
Oh, I didn't either, but the biggest thing with this when you're trying to decide, and this is a development in the last few years, is you're seeing a lot of companies do something called CDRs, and these are the same thing as the ADRs in the U.S., but this is bringing foreign companies to list and trade on the Canadian exchange in Canadian dollars or your U.S. dollars, but they trade in the Canadian exchange. And the big thing with here is you normally don't have to take on the currency risk, because if you're just buying Meta on the U.S. exchange and you're holding it in your U.S. dollar account, you've got a U.S. dollar exposure in your account, so you're not just taking a position in Meta and seeing how they do and whether Zuckerberg can grow the company. You're actually taking on a fairly big FX bet as well. But if you're buying it in Canada on some of the CDRs that are listed in Canadian dollars, you're really neutralizing the FX and you're focusing just on the company. So that's a big thing to developing out there. And you also do have a little bit of exposure getting rid of taxes. And I'm not a tax expert, but there is some U.S. withholding tax if you have U.S. stocks that have dividends. So you have to take that into account as well. So buying something on the CDR immunizes you on FX and also has some tax advantages.
So it's not tied to the American dollar at all then, the CDRs?
Some of them are U.S. dollar denominated. Most are Canadian dollar denominated.
And once you're out of it, once you've bought it, you're kind of separate from no matter what the dollar does. Huh?
Yeah, you'd be immunized from the dollar move and really just focus on the underlying move within the price action of the company.
Okay. Next up, an email from Sandy. I would appreciate your insights on whether freehold royalties would be a suitable stock to hold for the long term, particularly in light of the risks and volatility currently facing the oil and gas sector.
Yeah, the royalties are an interesting one, and I probably group Freehold in with Prairie Sky and some of the other royalty companies in Canada, which have been really well-run companies and have done quite well. But I think when you're looking at royalties, what you really are taking on, you're taking almost all commodity risk, and that's probably, most people would like that as a positive thing, and that's why you normally see royalty companies, and whether that's oil or gold or other commodities, the royalty companies usually lead first as a move starts, because that's what generalists will buy. That's what a lot of retail investors are comfortable with. And then as the cycle starts to mature, then you start going to producers, then the mid cap, and the last thing to go are always the juniors. So the royalty companies are generally thought of as the safest because they don't take on any operating risk, and but they really are just tied to the commodities. So these companies have gotten a little expensive of late, so a lot of people are making the recommendation to move away from the royalties with an energy towards more of the producers who have lagged. But they are generally thought of as safer companies because, again, you don't take on the operational risk. You're just really focused on the commodity right now.
And is it still moving to the producers, or are we moving beyond that even?
In the last few weeks, we've seen more people start to move away from the royalties towards the producers. We saw C&Q and Suncor have had big moves, but now it's starting to broaden out towards the white caps and some of these more mid-tier names, which are more sensitive to the oil price and look like they're still lagging on evaluation compared to some of their peers.
And how long does that last, that cycle?
Well, it all depends.
It all depends, of course, but like, is there an average kind of length to it?
Well, the gold cycle, you could argue, lasted about 18 months last year. As we started with the royalties going off 2 years ago, and then the large caps, and then really last year we saw the juniors and the silver companies, which go last, kick in. So that probably lasted 12 to 18 months, and most cycles will probably be in that range. But given given tweets right now, who knows what's going on? Everything's got a caveat right now.
6 minutes.
Exactly.
Right? It's lasted 6 minutes. We're moving on to something else now. It really is one of the more interesting times, isn't it?
It's definitely not boring. Yeah.
Okay, so this cycle is at 6 minutes. That's what we've decided now. All right,
Okay.
We'll wrap it up there.
Perfect.
Thank you, as always, for joining us, Greg. Appreciate it. That is it for us here on the street. Greg Taylor is the Chief Investment Officer with Pender Fund Capital Management. He was joining us today. Andrew Bell's up with the open next. Trading gets underway in a little more than 30 minutes from now. Have yourself a great day.